Monogram Industries. This was a newer company that wasn't very well known at the time. In fact, they had new management, and I can tell you an interesting story on that. The new management got together in a boardroom, and they had little cards all over the table listing all the different employees. And when the new management came in, the company had had some troubles in the past, and they were told that they could have half of the cards, and they picked the ones they want. And that was kind of a brutal way of determining something, but the company had to make some changes, and that's how it was done. So they picked the ones that they thought were the best people, and some of them had to let go. But there's a big turnaround play at Monogram, and you can see the 17-week base there. One of the things that I do sometimes is in the prior uptrend to a base, you look for some big spikes in the volume, and that's showing you that there's big buying going on, and that's not the public doing that. That's some institution or some big person going in and saying, buy me 100,000 shares or 50,000 or something of that sort. That's what causes those spikes, and you like to see them because it's saying, hey, there's important money going into these stocks. So that shows up on the prior uptrend to the 17-week base that breaks out in the December 66 quarter. Then you run straight up, and that one rule that we have of when you break out and you go up 20% in less than 3 weeks, I think comes into play here, meaning that if that happens, you have to hold it for 8 full weeks. So let's see, 1, 2, 3, 4, 5, 6, 7, 8 weeks get you into the latter part of that flat base that's going sideways. It has 4 tight weeks, and seeing all of that, you are going to stay with it longer, and it comes out a week or 2 later and takes off and really starts to run. So you had a point to add there as you're breaking out of that area, and you're seeing you had your 4 tight weeks. We take off and run. Actually, you're 1, 2, 3, 4, 5, 6, 7, 8 weeks in a row. And I think earlier on I mentioned that when you're going through a chart and it takes off and runs up 8 consecutive weeks in a row, that's telling you that this has such steady power and momentum that it's probably going to ultimately go a lot higher, regardless of the fact that it's gone up in that last 8 weeks. And this is a good example of that because you come from a split-adjusted 12 to 80. So there was your example. So when you're counting weeks and you see 1, 2, 3, 4, 5, 6, 7, whatever, and in another case you have 1, 2, 3, 4, 5, 6, 7, 8, just remember that's telling you something. Now, yes, it's extended and you may build another base, but in fact, I counted some of the real past winners in the past and found if you had 5 weeks or more in a row going up, coming out of a base, or as it's emerging from the base and whatever, anything from 5 on up is worth noting because that's abnormal. So if it's 5 weeks, 6 weeks, 7, 8, 10, 12, whatever, they're all telling you a message that, hey, this is getting steady, consistent volume buying, and that's not the public. Because the public isn't concentrated like that. Those are institutions or big professional buyers in there. And this gave you that evidence several different times. In fact, if you wanted to get it from the bottom, you had 1, 2, 3, 4, 5, 6, 7 weeks. Then again, you had 1, 2, 3, 4, 5, 6, 7, 8 weeks. And then 1, 2, 3, 4, 5, 6, 7, 8 weeks before you got to the point where you built this base that comes out and has 1, 2, 3, 4, 5, 6. Let's see, 1, 2, 3, 4, 5, 6. And then it comes out in 1, 2, 3, 4, 5, 6, 7, 8. It just keeps doing this. And after that, it still goes from 20 to 80. So I'm giving you little clues of things for you to look at. And 5 weeks to 10 weeks in a row up means something. And the public doesn't buy stock that way. We're calling all our aunts and uncles and cousins and say, now you buy it this week. Those are professionals buying that, making that happen. So you have to be able to count past 4 or 5. So take your shoes off and use your fingers and count to 20 if you have to. Let's say that you're now in charge of this institution and you got $5 billion under management and you want to have a 2% position in this stock. Well, what's 2% of $5 billion? If you're at home, you can put all the zeros behind it and tell me what that is. But it will be such a big number that you cannot buy all that stock in one day or even 1 week. And also, you don't want to give away the fact that you're in there buying the stock, so you will slowly and steadily be buying at a slower pace during a day and during the next day, and maybe you'll buy for 4 or 5 days in a row, and then you'll back away for a day or two and see if the stock will settle down a little bit, and then you come back in and start all over again. So if you're a big institutional buyer, you may be buying this stock for 4, 5, 6 weeks, or 8 weeks, or 10 weeks, depending on what you're trying to do. And that's part of what you see in some of these stocks. When I'm saying you count 5 weeks in a row, or 8 weeks in a row, or 10 weeks in a row, somebody has done a lot of work on the company and they're buying it 8 weeks in a row. Or somebody's buying it 5 weeks and somebody else sees that and starts figuring it out, and now they're buying it for 3 weeks more. It's all professional buying pretty much, because it's not the public that all of a sudden all the housewives are talking to each other on the phone and they say, oh man, we got it in the next 2 weeks, we got to buy this every day. First of all, you run out of money because you buy 100 here and 100 there, and money's gone. But the institution has billions of dollars and they can buy whatever they want, and they're the ones that make these moves. So monogram, after it comes out of the 17-week base, it goes at 1, 2, 3, 4, 5, 6 weeks, and that fact tells you that has a chance of being a big stock, and it winds up going from 12 to 80. So that was just the opening part of the stock. It's now really starting to have its move that was telegraphed by what had just happened. Now, another way of looking at this, at the end of that 6 or 8 weeks that it runs up in a row, what does it do? It goes straight sideways and doesn't give much ground. And in fact, 4 of the weeks are tight, closing at the same change. So the professionals are buying the stock, supporting it there. They're saying, oh, finally it backs away a little bit and we can slowly and quietly accumulate it around this price that's around the $12 price. And they're sitting there for 5, 10, 15, 20 days, slowly and quietly accumulating it. Nobody's paying any attention because it's not moving around much, and they pick up the paper and it's up a quarter or down a quarter, and nobody's paying any attention, and they're able to accumulate more stock there. And then suddenly it takes off and starts running again. So after it runs again, it has the 7 or 8 weeks in a row and telling you, okay, it's headed higher, and it builds an ascending base. Now, you can't tell the ascending base until you finish it, but normally in the second little pullback, you start getting suspicious. Hey, it looks like this is building an ascending base, because you had your first pullback and you go back into new high ground. Now you're getting your second pullback, and you can start figuring it out somewhere in your second thing that, hey, it looks like it's building an ascending base. And when it comes out of that, sometimes you can buy it and add to it. Then we run up and we form a cup with a handle. Notice that on that first attempt to break out, it drifts back for 3 weeks in the red, but it doesn't drift hardly at all. It's virtually unchanged every week. And then it bounces out of that and goes from 40 to 80. So all these little clues you see in a pattern. In your reading charts, you want to see the cup with a handle, the double bottom, the flat base, the high type flag, all these different bases. But you also want to recognize little symptoms that occur when you take the base apart and look at each week. Say the first 3 weeks pulling back in the handle, each week dries up in volume. So there's no selling going into the stock as it has its handle. And it comes out and tries to break out. And now it goes very tight, drifting off slightly, but not very much. And if you want to look at that 3-week pullback, which was in the week, it looks like it's in the last month of the September 67 quarter, look at week by week check, and you'll see the first week closes in the red, but it's just down slightly, and the volume's up, but it didn't go anywhere, so it doesn't mean much. It's tight. And the second week, the volume is down, and it closes down, but it doesn't really go anywhere. It's just down a little bit. Now, the key is that the third week is down again, but it's down less than the second week was down, and the volume was up, and that's accumulation. If I can go over that and explain it from another point of view, you're going down 1 week, you're going down 2 weeks, and now you're going down the third week, but in the third week, the volume picks up, and you stop going down at the rate you were going before. That is accumulation. Now, that is a minute detail that most people are not going to tell you about and you might not ever figure out. But you need to analyze and recognize here's the shape of a base, plus you need to look at week by week. Each week, did it do what it should do at that particular point? You're coming down and say the left side of a base for a week or 2 weeks or 3 weeks, it should handle itself in a certain way. And you can expect if that's the beginning of the base, you might get a few bad weeks in there because there's some selling. But now when the volume comes into it, does it retrace most of that move and gets back up to within 5 or 10% of the high? If it only retraces a small amount and it's in the lower part, that's a weaker structure. But it get in the upper part, and then if it pulls back and the volume dries up, now you're getting exactly what you want. So there is a pattern recognition, and then there is the week-by-week analysis on a supply and demand of price and volume, and how is it changing each week? Is it doing what it should do, or are there giveaway signs that say the third week down doesn't come down very much at all, but the volume picks up? That's support buying. Now, if it's drying up, there's no selling coming in. But there can be some other signs that are not good. In other words, the volume picks up and it closes down a little bit more than normal. That's not good. That shouldn't be operating that way in the handle area. Okay, so we come out with a cup of the handle and we take off, and now we run into a climax top. And, of course, you know what the rules for that are. You sell into it because it's going to top and come down pretty fast. And, of course, this one went from 80 to 55, and I suspect it went a lot lower than that if we plotted out the next 2 years. The premium comes with buying on the first base that's sound, or the second base, so that you've now got a cushion. So I bought it at $8, and I added some more at $12. I figure out I've got an ascending base when I'm in the second correction, and that's around 22. But I'm already up from 8 to 22. I've got a huge cushion. Now I got that cushion, and I'm analyzing the current thing and seeing, okay, this looks like it's going to be building an ascending base. It takes off and runs the third time up and then pulls back, and you say, yeah, it is. And now you've got another point. You buy some stock coming out there, and eventually you build another base. So I would not want to sell it pulling back in that third thing when you've had two, in effect, base on bases, and you look like you're in the third process. And particularly, I have my cushion. Now, if I didn't have a cushion, in other words, if I started buying it at 24 and I'm chasing it a little bit or something, now it's a whole different ball game. And selling off like that, I'd be cutting back. But I don't want to be starting it at 24. That's not exactly the right place. So, again, you see, if you buy the wrong place, you usually get into trouble. Or how are you going to buy right if you don't use charts? So you may not believe in them. So just tell your doctor never to have MRIs or all these other gadgets show charts and are supposed to tell them something. No, you want facts, and these are plotted out facts, and you can interpret them and materially improve your results. This firm would not be here if it wasn't for charts. I used to call these, I think, cousin stocks or something, but if you have an industry that is booming, in that case, the airline industry had jets, and everybody was traveling now, and the airlines were really making a lot of money, and the airline stocks are taking off and really running up. So is somebody a supplier to the airline stocks, or is there a follow-on beneficiary of that? Well, the follow-on beneficiary is that, wow, if everybody's now flying jets, that means they're traveling to cities, and then there's probably going to be a shortage of hotels, and so maybe I better be buying Hilton hotels. So there are cousin relationships related to a certain industry, and they're selling something that's important. There are special kind of toilets in an airliner, and they're different than the one that you have at home. And they're making them.